Hi, this is your host, Andrew Raffel, the founder and CEO of Baintree Wealth Advisors. And I wanted to personally welcome you to Your Wealth and Beyond, a podcast that will empower you, the entrepreneur and business owner, with the insight and information you need to effectively manage and control your personal and professional finances. My goal is to help each of you get your fiscal house in order so that you can take your business to the next level. We're going to be looking at things through a financial lens. I'm going to help you focus on growing your business, building your wealth, and most importantly, finding purpose in what matters most. Here we are. Welcome, everybody, to a brand new episode of the Your Wealth and Beyond podcast. I'm your host, Andrew Raffel. Pleasure to be here. It's been a exciting end to the summer, to say the least. I know a lot of you may be listening to this after the fact, but man, our reality out there is it's definitely a reality show. Who would have thunk it? But I'll tell you, the ratings are up across the board. Guess it's a good time to be in the news media because every day throws something at you that you couldn't even imagine. But I regress. This show isn't about that. This show isn't about the way my Browns lost last week in Oakland, and I was actually there to witness it. We were in victory formation, and then the NFL stole it from us. But again, that's a whole nother diatribe. Today, we are going to jump in. Feet first, maybe a belly flop, could be a triple Lundy, or a cannonball, but we're jumping right in to talk about all things related to the health savings account, or more commonly referred to as the HSA account. And you know what? As planners, financial advisors, CPAs, those that are in the know that the HSA, if you qualify for it, it is the pinnacle, the best retirement account out there. And if you are not contributing to it, you need to take a step back. You need to look in the mirror and you need to say why. Now, here's a couple of caveats, and we're going to go through today some of the top 10 things to know about HSAs, and then also some tips on how to get the distributions out tax-free that may surprise you. So the HSA, the health savings account, why it's the pinnacle is that if you qualify, okay, and this is the big if, your health insurance plan, whether it be an individual plan or a work plan, has to be a high-deductible plan. Currently, 2018, for an individual, that means an individual plan has to have at least a $1,350 minimum annual deductible. For a family, that number is $2,700. So the rules are very specific about what plans qualify. So ask your employer, ask the benefits department. If you're on an individual plan, call up the plan itself. So that is very, very important. Secondly, there's certain limits to how much you can contribute. There's two ways you can contribute. There's you put the money in, or if you're fortunate, a company may add some money, but you can't go past the maximum amount. So for an individual, 2018, the max you can contribute is $3,450. If you're over 55, throw on another $1,000 on top of it. Families, $6,900. Again, over 55, you can increase that. It's called the catch-up, $1,000. Okay. So when you put that money in, similar to your 401k, similar to an IRA, similar to a SEP IRA, that money comes right off of the top. So it's a deduction off the top line. So if you think about it, if you're in the income bracket, and let's say you're making $200,000 a year and you put away $6,900 into the HSA, you get a full deduction on that, similar to your 401k. Now, it doesn't mean that you still can't max out your 401k. Put $18,500 in there, $6,900 in the HSA if you have a family. If you're over 50, you could put $24,500 in your 401k and $7,900 if you're over 55. So that money goes in. Now, depending upon the plan that you have the ability to invest it. There's different choices. So it's not just a savings account, but you can invest it in the same type of funds that you can in your 401k or a 529 plan. Very important to know what those options are, because really what you want to think of this, the real pinnacle to the benefit of getting tax deduction, then the money grows tax deferred, and then ultimately at some point, if used for qualified medical expenses, the money can come out tax free. So if you listen to why we call it the pinnacle, is that you get the triple whammy. The triple whammy, okay? You get the tax deduction, tax deferral, and tax free. It's the only retirement account out there that gives you all three. A 401k or an IRA gives you the first two, but then when the money comes out, in most cases, it's going to come out and you're going to pay taxes on it. In a Roth situation, you do not get the first. You don't get the tax deduction, but you get the tax deferral and it's tax-free when it comes out. So when you think about the triple combo, that's why we call it the Cadillac of retirement accounts. Okay, so very, very important there. Now, a lot of you out there will use it, and I made this mistake too. Not a mistake, but I look at now a different option to really maximize the HSA. But what a lot of people do is they'll put it in, they'll put the amount in, and then they just take it right back out for prescriptions, for co-payments, reimbursements on surgeries. You can do that, man. So it's not a bad thing after all. You're putting in up to $6,900 as a family. You get a tax deduction, so you're saving potentially $2,000-$3,000. And then you take it right back out and it comes out tax-free. Not a bad idea. But more and more of us are under the mindset that we want this money in the years while we're retired, when we're going to have more medical expenses. So why not think about it more of a longer term account, put the money in, grow it, and then have it be tax-free later. We're going to start seeing more and more of this. As clients come our way, we're starting to see more and more of these clients with tens of thousands, if not pretty soon 6 figures in their HSA account. So you can use it either or, but think of it, if you can, think of it as maxing that puppy out, putting as much as you can, and then letting it defer as long as possible. Now, a couple of things in regards to how this can be utilized is that if it's your plan and in a family situation, we can use the tax-free distributions for a spouse, for a dependent. This is true even if your spouse or child is not covered under the HSA compatible high deductible insurance. So very important there. Now, also, when we look out at when you start taking this money out of your HSA, one of the unique things is that it can come out to reimburse you for medical expenses that were done in prior years. The key parameter here, though, is that the qualified medical expense had to have happened, had to have occurred after you had set up your HSA. So let's talk a real world example. Today it's 2018. Let's say you had set up your HSA plan in 2015. And in 2016, you went to the doctor and you had to get your knee scoped. Well, that payment, whatever your insurance company made you pay back in 2016, you can actually reimburse yourself today in 2018 out of your HSA. So it's very flexible in that regard. But again, the most important component there is that medical expense had to have happened after your HSA was taken out. You can also name a beneficiary to your HSA. If it's your spouse, the HSA will become theirs and continue to be used tax-free for qualified medical expenses. So it's similar to an IRA transfer. A spouse will continue into those type of things. So HSA, the Cadillac of the retirement plans, we recommend if you can qualify and you do have the money that can be put away, you got to do it. Especially if you're a business owner, especially if you're high income. If you're not doing it, go ask your CPA, your financial advisor, why am I not doing it? And they may tell you, you should be doing it. Well, why didn't you tell me to do it? Well, I didn't really know that you had it. Well, we got to ask these questions. As advisors, you got to ask your clients these questions, and clients, you got to ask your advisors. You got to be proactive. A lot of times Everybody's reactive. Now, when we look at some of the ways on how we can get the money out of the HSA, there's the basic, which we've talked about. You can take the money out for qualified medical expenses, and it's more than just doctor bills. This means you could take out tax-free distributions from your HSA to pay doctors and hospital bills, but also medical supplies, prescription co-payments, dental care, vision services, even in some cases, chiropractic expenses. So there's a full gamut on how this money can be used. And it's something that, again, you can use it as a slush fund. What goes in comes out. When it comes out, you got a lot of different ways on how it can come out. You can take these tax-free distributions from your HSA to pay for your spouse or child's medical expenses like we talked about. So that's one that a lot of people don't realize, even if they're not on your plan. Now, here in 2018, you can take from your HSA, talked about this a little bit before, to pay for expenses from a previous year. Again, as long as those expenses were incurred after your HSA was taken into account. So you can reimburse yourself later. That's, again, that key of that compounding. Let the money grow and then reimburse yourself at another time in years from now. Even if you no longer have a high deductible plan and you're no longer allowed to contribute to your HSA, you can keep your HSA and you can continue to take the tax-free distributions from it to pay for those medical expenses for you, your spouse, and any of your dependents. So just because you're not contributing doesn't mean that you have to disband the account. A lot of you remember the flexible spending accounts. Those had to be used towards every year. In this case, the HSA can continue to live on even in a lot of different circumstances. Now, here's something. Once you reach or enroll in Medicare, so reach that magic age of 65, you are not allowed to contribute to your HSA. You are not allowed to contribute to your HSA, but you can still take tax-free distributions for qualified medical expenses. And here's another real big benefit of the HSA. When you reach 65, normally you can't use your HSA to pay for insurance premiums, right? You can't use it to pay your health insurance premiums. But after the age of 65, or at that age, and you're enrolled in Medicare, you can take money out of the HSA to pay for Medicare premiums, excluding Medigap. Okay, so you can use it for Medicare premiums, excluding Medigap. So that's something that a lot of people don't realize that you can do. And as we talked earlier, the HSA, you can list your spouse, and after your death, he or she can maintain the HSA in their name and can continue to access the funds. Now, there's one little caveat too, and it's not so much of a home run, but there's a certain rule that allows you one time to fund your HSA with qualified retirement money, meaning coming from an IRA. So that money can come out of the IRA. It can directly transfer. You want to do a trustee to trustee transfer, but it can go to fund your HSA account. So where that could work well is if you took out money and you took $6,900 from an IRA where you got a tax deduction. Of course, that money is going to go into the HSA. There's no taxable consequence right then and there. And then when that money comes out, unlike an IRA, which is going to be taxable, you've now taken IRA money, moved it to the HSA. And now with that HSA, that money can distribute out for qualified medical expenses, for medical bills, for prescription drugs, for Medicare payments. List goes on and on and on. But that money comes out tax-free. So that's a little known fact. It's not always in everybody's best interest to take from retirement money and to move it there. But in a sense, both accounts are retirement vehicles. One's just used for the healthcare. One's more used for living expenses, which ultimately include healthcare. So today's episode is going to be short and sweet. If you have the ability to contribute to an HSA and you're not doing it, you need to find out why you're not doing it. Meaning, look to yourself and say, can I afford to do it? The other caveat is that if you are, getting a 401k matching, make sure you at least put enough in to get the matching, but then you may want to look at what the additional amount of money that you can save and try to earmark a little bit into the HSA account. The reason we've talked about tax deduction, money grows tax deferred, money comes out tax free. Pretty good deal, right? So make sure that you look at that. You understand first if you're allowed to do it. That means you have to make sure your plan meets the minimum annual deductible, meaning it's a high deductible plan. And then also ask your company, will they fund your HSA for you? Some companies will do that. Now, you can't go above and beyond the contribution limits. Unlike a 401k where if you put in your 18.5 and they're matching you 5%, you can go over that 18.5. In this case, you are maxed out at that limit. What we're hoping that the government will do, and the Treasury and so forth, will increase the amount that we can contribute to an HSA. Why not, right? Let's contribute more. Maybe they'll change it where then companies can match. Why not put the onus on us to save if we can and make it beneficial by giving us some tax breaks? Because at the end of the day, that's going to take some pressure off of the government. So that's what we're hoping for. But until that time, I would highly advise if you're using your HSA as a slush fund, see if you can stop doing that and look at longer term, letting that money grow and compound and be there for you. But most importantly, if you have the ability to do an HSA and you're not, make sure that you take a good hard look at it because it's one of the best vehicles out there that will help us all pay for that big wild card, which is healthcare, which we don't know what it will be in the future. So that's it today. If you have any questions at all underneath the show notes, there's going to be the ability to contact us. We can run an analysis. We can walk through with you how much it's going to be in tax savings. We can just go through general questions that you may have. That's what we're here for. If we don't know the answer, we'll tie you into somebody that is a license in the healthcare space. But that's what we're here to do at Baintree. That's why we do the Your Wealth and Beyond podcast. Let's get out good information to you. That way you can make good decisions. All right, guys. Well, I'm signing off. We'll get together again later this month for a new episode of the Your Wealth and Beyond. Make sure to subscribe to our show and let your friends and family know that this show's out there. We really appreciate all of the feedback and the downloads, and the show just keeps getting stronger and stronger every single month. So thank you guys. And if there's ever a guest, if there's ever a topic, if there's ever a question, just reach out to us at questions@baintree.com. We'll make sure we get either the answer to you specifically, or we'll make a whole segment on it here at the Your Wealth and Beyond podcast. I'm Andrew Raffel. I appreciate the time. We'll talk soon. Thank you for joining me for today's episode of Your Wealth and Beyond. To get access to all the resources mentioned during today's podcast, please visit baintree.com/podcast. And be sure to tune in later this month for another episode of Your Wealth and Beyond.